Alright guys, welcome to the option selling playlist. In this playlist, I'm going to cover how I'm able to generate thousands of extra dollars every single month, selling options on both high beta and blue chip stocks. Now, in order to explain this fully, I am going to have to cover options from a very basic standpoint, and then I will go into option selling and how you can use it to generate that extra income every single month. I'm going to try and make this as simple as possible, even though it can seem complex, especially to beginners, but let's get into it. Alright guys, so let's start from the basics. What is an option? An option, just like the name states, is an option to buy something. So for example, in this case, an option is actually a contract. Let's draw a little nifty contract here between a buyer and a seller. Just like you can buy an orange, sorry for my drawing here, or a banana. In order for somebody to buy this orange, there has to be a seller, right? If you want to buy an orange, there has to be someone selling it to you. Just like a banana, if you want to buy a banana, someone has to sell it to you. With options, there is a contract that is entered between a buyer who's willing to buy the contract and a seller who's willing to sell it to them. So for example, if you and I are betting on a horse race, I know this is kind of a random example. So if I think that horse A is going to win and you think horse A is going to lose, you and I can enter into a bet, right? And the reason we're able to enter this bet between each other is because we have conflicting ideas as to what's going to happen in this race. I think that horse A is going to win and I'm willing to bet money on it, and you think horse A is going to lose. You are willing to enter this agreement with me or this contract and be on the other side of the trade. Because you and I have differing opinions, that allows the contract to exist or the bet to exist. The same thing happens in the options market. If we are talking about a specific stock, if I think the stock is going to go up while you think the stock is going to go down, you and I can enter into a contractual agreement or an options play between the two of us for that specific stock. Now, from a very basic standpoint, guys, if you are betting on a stock going up, you will be entering into a call. If you think that a stock is going to go down, you will enter into a put. These are the two basic types of options. A call is bullish, a put is bearish. Now, if I am the buyer of an option, whether it be a call or a put, I'm essentially being given the right to own 100 shares of that specific company. So again, guys, very briefly, an option is a contract, a contractual agreement entered between a buyer and a seller. And the buyer of the option has the right to own 100 shares of that company at a specific price. Again, excuse my handwriting if it's kind of funky, but that is essentially the basics of an options contract. All right, guys, so before we get into this, I want to quickly make an analogy for you guys. It's going to make this a lot easier to understand. Let's pretend that we are in a horse race, okay? These are my horses. Please don't laugh at my drawing capabilities, but this is horse A and this is horse B. This is the track, this is the halfway point, and this is the finish line. So I'm going to label this as H for halfway and F for finish line. Me and you want to make a bet of which horse is going to win, and that bet is going to be for $100. At the beginning of this race, it's a fair fight. Both horses are at the start line. Nobody knows who is going to win, so it seems fair to bet $100, right? But let's say now the horse race goes on, and horse A is already at the halfway line, and horse B is maybe this far from the start line and this far away from the half line, meaning that horse A is in a much bigger lead than horse B. Would you still be willing to pay $100 for this bet? Probably not. In this situation, if horse A is already close to the halfway point and horse B is only over here, then the odds of horse A winning are much higher. If you are betting that horse A is going to win, you might be willing to pay $150 for this bet because you know the odds of horse A hitting the finish line first are much higher. And let's say the reward here was $200 for your horse winning the race. If you see that horse A is much closer to the finish line, you'll be willing to pay maybe $150 for that bet because you know that you're going to make $200 at the end. But if you were betting on horse B winning this race, would you still be willing to pay $100 at this point in time if he is losing? No. You'd probably only be willing to pay, let's say, $50 for this bet because the odds of horse B making it to the finish line first are much lower. So just like the horse race, guys, options works the exact same way. We know that buying a call is bullish, meaning you think a stock is going to go up. Buying a put means you're bearish, meaning you think the stock is going to go down. So let's use Tesla as an example. Let's say I'm bullish on Tesla and I want to buy a call on Tesla. Let's say I pick the $270 strike price, meaning that I think Tesla is going to hit $270 a share by a specific date. This is a very important part. Just like with a horse race, right? As the horse race goes on, the value of the bet either goes up or down, right? Depending on whether your horse is in the lead or not. The same thing applies to options. Time is a super important factor here. So let's say the date today is January 1st, 2025. And I think that Tesla is going to hit 270 a share by February 1st, meaning within 1 month from today. So I am buying the 270 call expiring February 1st. And again, we're just saying February 1st for simplicity's sake. This is kind of more complex, but most options expire on Fridays of the week or of the month. I don't know if the February 1st for 2025 is a Friday or not, but regardless, let's just keep this simple, okay? So let's say that I am willing to pay $100 for this. And again, when you log into your brokerage, okay, there's a whole list of options of what call and put options you can buy. And there's actually already a set price that you will select. So I will show you guys this in a later example, but for simplicity's sake, let's say that the cost of this option is $100. Just like with the horse race, we were betting $100 on which horse would win, which horse would lose. In this case, we are betting $100 that Tesla will end up at 270 a share by February 1st. So I'm going to take you guys through two specific examples, but let's say it's day one, right? It's January 1st, and Tesla is currently trading at $250 per share. Okay, at this point, the bet is even. I am willing to buy this call for $100 and I am selling it to the option seller who is accepting the $100 from me. And now let's say it is day 15. It is now January 15th and Tesla is trading at $265 per share. Think of this like the horse race, right? If I'm betting on horse A being Tesla, and Tesla is moving fast close to the finish line, right? It's at $265 a share, very close to that 270 strike price. Then the $100 we paid for this options contract is probably going to be worth more. Maybe at this point now, it's going to be worth $150. So essentially, guys, the faster that Tesla moves towards our strike price of 270, the more value our contract is going to have. And in this case, we're saying, for example's sake, it moves from $100 to $150. So you made a $50 profit or a 50% profit on your money. But let's say the exact opposite happens. It's day one and Tesla is trading at $250 a share. But now imagine it's day 15 and Tesla is now trading at $235 per share. What do you think this options contract is going to be worth? Think of the horse race example, guys, right? If you bet on horse A and now horse A is actually slow and he's not in the lead, right? In this case, we jumped $15 a share. Here, we actually dropped $15 a share. So we are much farther away from our $270 strike price by day 15. So do you think that this bet is still going to be worth $100? No, probably not. At this point, your options contract might be worth $50. So again, guys, it's all about the strike price you select and the amount of time on the contract. Because we only have a month on this contract, we're already halfway through the race in this case, and Tesla is far below the price that we needed to be at. So the odds of us ending up at $270 for Tesla by February 1st, which is only 15 days away, are much slimmer than they were in this case, where we're already at $265. In this case, we're $5 away from our strike price. In this case, we are $35 away from our strike price. So you should understand intrinsically why this contract is worth $150 and this one's only worth $50. The odds of your strike price hitting here are way higher in this scenario than in this scenario. So again, guys, the point that I want to reiterate here is that time is the most important part of an options contract, as well as price moving in the right direction as fast as possible in relation to the amount of time on your options contract. So we measure time in options, and that's with Greek symbols. And the most important one relating to time and time decay is called theta. We'll go into this in more detail, guys, but this is the very basics here. We're going to go into a brokerage and I'll show you guys how this looks on an actual brokerage account. All right, guys, so that is the basics of options as a whole. That is not really related to option selling just yet. I'm going to cover that in later videos, but I wanted to give you a basics of how options work, how they move, why they move, time decay, etc., etc. The next video, we're actually going to go into a brokerage account, see what options buying and selling looks like on a brokerage account, and then I will go more into detail about theta, what option selling really is in comparison to option buying, which we just covered. We're going to go into option selling next. I'm going to show you guys how I implement that strategy into my portfolios to make monthly income on top of the long-term investing, the swing trading, and the day trading. So stick with me, guys, till the next video that comes out next week, same day, and I will see you guys then. Peace.